with large cap stocks, like a 30% return is good. With small cap stocks, a 30% return is not even worth your time. So it's like a very tricky. So Warner Brothers Discovery is like a recent merger, gigantic reverse merger, basically. I really want to eat this bagel that's been sitting on my desk. 2 billion shares outstanding, $8 stock. You do the math. What is that? 2 times 8. 8 and 8, 16. Half of 8 is 4, and that makes 20. Quick math. Okay, distribution, advertising, content. Could it be any less descriptive? And other. So distribution is probably what, TV? Advertising is what it sounds like. Content is like probably film or other media. 10 billion in revenue. Not growing, they actually shrunk. Classic media for you, right? These guys are just getting owned by social media. What would you rather watch? Media about literally you and your life, or about people you don't give out? Social media is just like genius idea. It's like top 3 ideas of humanities from all time. You got the wheel, you got fire, and you got social media. Prey on people's narcissism. So Warner Brothers Discovery is this like gigantically debt-loaded company because they did that merger. So they actually, I mean, it's kind of nuts. This is a good example of like talking about enterprise value real quick. So Chad, I want you to pay attention in case you haven't heard this for the zillionth time. I've given this lecture 100,000 times. I'm going to do it one more time. I hope Shkreli Pill or somebody like that understands it or shows it. All right, so you got the stock price. We all understand stock price, right? Like it's just something you can keep on your screen. And in this case, it's like $8. In fact, using Godel, if you're so inclined, let's say you're the CEO of Warner Brothers or something. Oh my God, I got so many. And you're like, all you care about is Warner Brothers stock. My favorite feature, Godel. It's such a small, lame feature, but I just love it. Like I could just make a gigantic like Warner Brothers Discovery stock price. So you have this stock price, and it changes every second, and we kind of know why and where and when that happens, right? So that's Warner Brothers Discovery. Why it's not changing every second is another story, but it should be changing every second. Could be my computer, could be my software. Okay, it changed. So it's $7.98. It'll be $7.99 in a second from now, or $7.96 or whatever. So stock price is simple. That's really, really simple. Shares is a little less simple, but you can look up the shares outstanding. And really good investors know how many shares outstanding there are for all the companies in their portfolio. Challenge yourself to think, do you know how many shares outstanding there are of your favorite stock? It's important. You should know. Because that's how many shares the business is divided into. And for this company, it's this massive number. I'm going to use this big number, 2.4 billion, which makes sense because like, if one share is only $8, you're buying a share of a business, like that's not, a lot of money, $8. But when you see how many shares there are, well, that is a lot. So if I just own one share, just a 0 turns into a 1, or maybe a better way to do it is like here. Like this is how many shares there are, and this is how many I own, just one out of 2.45 billion. I don't own that much of Warner Brothers. But let's say your dad was John Warner or whatever, and he created Warner Brothers a long, long time ago. And after all of the inheritances and splits and so forth, you owned 1 million shares. What does that mean? You have $8 million, right? Because each share is $8 and you have 1 million, and you could sell them for around $8. Maybe it'll be $7.95, maybe it'll be $8.05. Maybe it goes up a lot, it goes to 10, but you own 2,450th of Warner Brothers, not quite 1%. Let's say John Warner, or whatever his name is, I'm just making that name up, was very generous, and you had no brothers and sisters, and you were the sole heir, and you had 24 million shares. So what is that, chat? Like 150 million, maybe 200 million? Yeah, maybe $200 million. And you own 1% of Warner Brothers. Well, what if you owned 99% of the shares? What if you owned like, I don't know, 2.4 billion, and there was only 50 million shares publicly traded, but your shares, you own like 99% of the company. Well, I would just multiply that times 8, and that would be what's called the market cap. So that's just all the shares outstanding times the current share price. And we did that earlier. That calculation came out to be 19.6 billion. So that's what this company is worth. When we say, what's the market cap? That's kind of what the company is worth. And this number is called the shares outstanding. And this number is called the stock price. If you understand all this, like, you're actually got a good ways of like stock market 101. If you really understand this, you're sort of past stock market 101. Now stock market 102. It's going to be a little harder. And this is a really perfect company to teach the stock market 102. And stock market 102 revolves around this concept called enterprise value. So market cap is how much it would cost, right, to buy all of the shares, roughly 20 billion. And that's important because if somebody says, well, Warner Brothers makes 4 billion a year, well, that would only take me 5 years to buy, for Warner Brothers to make all of its money back for that 20 billion, if that makes sense. Like, it would be such a good deal if Warner Brothers made 4 or 5 billion a year. But if you told me Warner Brothers only makes 50 million a year, well, 50 million is a lot of money to anybody, but that would not be worth 20 billion. $50 million a year income company is maybe worth like 1 billion. So I would avoid Warner Brothers stock if that was the case. And of course, we can look at the financial statements and decide, well, what is enterprise value? Well, it's part of an equation that's really important involving cash and debt. Warner Brothers has cash and debt. Why? Well, any business has cash and debt. Debt's not necessarily a bad thing, by the way. You might borrow money to buy another company, which is what happened here. But what if you owned all those shares again? Let's go back to John Warner and you inherited all of Warner Brothers. So you inherited every single share. And the company has cash in its bank account because it's a company, right? It has to operate. And how much cash does it have? Well, you can look it up. I looked it up in the 10Q, and it's 2.9 billion. It's a lot of money, right? And you say, hey, I own all the shares or most of the shares of Warner Brothers. I want you to give me all that money. The CFO would have no choice but to say, okay, where should I send the money? Because it's your money. You own all of the shares outstanding. And if you went on the stock market and you had the money, maybe you're Warren Buffett, and you started clicking buy on your Robinhood, and you spent all of your money or some of your money or whatever buying every share of Warner Brothers, you actually also own the cash, right? You own all of the assets of the company. You own the movies. You own the TV channels. You own the movies that haven't been made yet. You own the video games. You own everything. And they have a lot of stuff. You own Bugs Bunny, which I think is a Warner Brothers asset. All of those things become yours. And the company's still making money and so forth. But the company also has debt. And if the company has debt, you also owe that money. Now, it does not personal recourse to you, but the business, the debt of the company is gigantic. It's $42 billion. In fact, they have more debt than the company's worth. It's pretty wild. $42 billion of debt and $3 billion of cash. So if you were to buy this company out and you tried to wire out this $3 billion, the problem is your lenders would say, wait a second, you got to pay me first. You owe $42 billion. And the business is only worth 20 billion. So the enterprise value is a way of reconciling all of this. So what we do is we do enterprise value is equal the market cap, which we get from over here, the 20 billion, minus the cash plus the debt. And that's the enterprise value. What's important is to answer the question of why. And there's a lot of ways to answer this question. But again, if you think about the stock as this box, when you buy a stock, you're buying a piece of the box. What's in the box?
all of the company's assets, which I'll say are green, like cash, property and plant, intellectual property. But you're also buying a share of the debt, of the accounts payable, things like that. And the stuff in the box determines, in some part, what the company is worth. So if the stuff in the box is negative 39 billion of cash, you have to take that into account. That when you pay 20 billion for the box, there's negative 40 billion in the box too. So the enterprise value we calculated is 59 billion. It's $59 billion. So if the company makes 5 billion a year, it's a lot less attractive than we thought. Why? Well, we have to pay this debt off, and it's going to take us 9 years to pay that off. And then it'll start going to the cash, bank accounts, which are yours, but you still have to now get this debt lower. So the enterprise value is often what I look at instead of the market cap. Often they're pretty similar. In this case, they're wildly different because Warner Brothers has so much debt. Sorry for the basic example, but sometimes I want to make sure you understand Wall Street 2.0. I'm sorry, Wall Street 102 or Stock Market 102. 101 is pretty easy. Now, as you can see, Warner Brothers makes a ton of money. In fact, before interest and taxes, they're making like 6-7 billion a year. So they're going to pay off that debt pretty quickly. And by the time the debt's like half paid off, it basically is like they not affecting the company. Right now, there's so much debt, they really have to kind of get rid of it. But the way you get rid of it is with your profits. And $1 billion every quarter means it'll take about 40 quarters before the debt's gone. 40 quarters is 10 years. Like other companies, they have a cash flow statement. The other weird thing is that this isn't a growth company. It's an old media company that isn't that exciting. They're not doing exciting things. No media company really is doing exciting things. Media is being torn apart by the internet. Now, some managers are really good and they find a way to grow, even if they're in a crappy industry. And I would argue that right now the media industry is a pretty crappy industry. But once they get out of all this debt that they had from combining Discovery and Warner Brothers, or basically AT&T owned Time Warner, and they merged Time Warner with Discovery. I'm trying to understand the business a little bit better. Okay, so Studios so they released Dune, Hogwarts, Aquaman, and then there's Networks. Networks is TNT, like all the normal Time Warner stuff. And then they have HBO Max. So content is films. ETC is HBO Max. They closed in 2022. Okay, Warner Brothers Motion Picture Group, Discovery Channel, Game of Thrones. It's interesting, social media, like people making their own content, like in Adin Ross or whoever, and then celebrities kind of owning their own ability to make content on Instagram or on wherever. That's kind of killing these companies. And it's hard to have a 360 deal with somebody like The Rock or something like that. Like he's got his own assets and companies. All right, so here again, they have distribution. So annoying. Advertising and content. But earlier, they said it's Studios, Networks, DTC. Studios seems to me to be content. Networks to me seems to be distribution. Maybe advertising is networks. Okay, they have EBITDA by segment too. So networks is their most profitable segment. At least that tells us something. Yeah, I get that like all three of them are in different buckets. I sort of get that. But it's just like content is like, okay, so within studios, I see. It's all content.
So all of the studio's revenue is recognized in content, which makes sense. Within networks, all of it's recognized in distribution. Well, not all of it, but like half distribution, half 54% distribution, 39% advertising, and the rest content. So what's the rest? 87%. They do CNN, they don't charge for the content, they charge for the advertising. They get a little bit of content, maybe from something or other, but CNN Plus or something, I don't know. But most of it's distribution to like Comcast pays them, and then they get some advertising. And then DTC is all distribution. But net, the company is not growing. And I'm happy about this. It's making it personal for a second, but quarterly it's not growing. After the merger, obviously they went through a gigantic growth. Let's assume that they have the same operating results forever, which kind of is like what media is, right? Like Looney Tunes and some of these films and stuff like that, they're like very, like Warner Brothers has been around forever, right? A lot of us grew up with Looney Tunes. I know I did. To me, like, companies like this will always have like a way to exist. But like, I also think the nature of content is changing dramatically. CNN has actually grown quite a bit. So I'm not sure that's where it's going to come from. Eventually, CNN is going to kind of go away. I mean, cash flows have to go forever. Companies live in perpetuity. They're not like people. Will movies go away? I kind of think so, right? Yeah, a lot of this stuff, it could be like AI. So there's some threat that there's going to be some of this content going to social media. I mean, more of it, right? People might make their own movies, stuff like that. Maybe it gets easier to make content. In the past, it was harder. Celebrities make their own content, so forth. Look at Mr. Beast, for example. So yeah, I wouldn't touch Warner Brothers. It's not compelling enough. Like the manager, Zaslav or whatever his name is, he's pretty good. One, I mean, this isn't my space. And to me, I also have an emotional hatred for media. So I'm like not the best person to like really look at these businesses. And the massive amount of debt like usually helps things kind of go wrong. It's a really big bet on content because like between HBO, films, and I would argue even CNN is content basically. It could be a UBI play. If you think about UBI, people have nothing to do with their time but taking content. But video games are also kind of a big competitor here. Video games and social media seem to be winning the content wars. Nobody wants to watch movies. You know, they want something cooler. If you think they'll grow at all, it's a decent buy. But last quarter they didn't grow. And all the stuff I'm saying right now, like, is it net positive for the company? Because some of this will help lower their costs too, right? It doesn't seem to be a net positive. I think it's a net negative. But I have to be open-minded about that. So like if they have a quarter where they grow like at all, it's really good long, I think. But they have to show a way to grow in a pretty tough media climate. Like TV is going away, right? So like how do they do networks? Like how does networks? Half their business, you know, is networks. They own game studios? Warner Brothers Games. Yeah, it's not really a serious studio. Hogwarts. Games are pretty low margin too. Games aren't exactly, they can be high margin, but they're the drop in the bucket for these guys. It's a content company. Most of these picks, so if you're in like Zoom or IO fans, they came from the Godel chat room. There's a lot of really smart people there. So if you want to join Godel and jump in the chat room, please feel free to do so. It's a Godel Num, N-U-M. It's $40 a month. The price is going to be going up a lot as we add more features. And it costs us money to add those features. So if you subscribe, you get to lock in your price for life, and you can also sell your account down the road. It's probably going to be pretty expensive because Bloomberg's $3,000 a month. But yeah, if you're in the Godel chat, I'm happy to look at stocks for you. And my method of looking at stocks, unfortunately, is so long. So if you just throw tickers at me, I'm not going to have the time to do that. But there's a lot of smart people there doing a lot of smart ideas. A couple of my very wealthy friends are in there too. So I have a couple of aces up my sleeve there. So some of the guys that have like names like Cat Guy 222 or Nerd Autist 135, some of those dudes are some famous guys. So Warner Brothers, I'm not so hot on. Like, it's okay.